Hey everybody, welcome to the weekly wrap up here with Trading Capital. And as we started off quarter two, there's some interesting price action to delve into, and we'll jump right into the S&P 500. And we're going to be touching base on the three big indexes and what is likely to transpire and what has transpired. So we initially had our massive run in the S&P, and this is intraday action. This is the 30-minute chart, but you can see here all the way roughly from the 415 area to the 462 area, it had a tremendous run, and the major trend that we were watching was this trend line here. And you can clearly see we broke that trend line 2 days ago, bounced off of the intraday 200, and we've made a new lower low on the charts. What we saw at the end of the day was the first quarter new buy money that usually comes from mutual funds and plans that are on those auto buy programs with people's retirement accounts, 401ks, and etc. And the end of the day, that's when the last hour, that's when the mutual fund buying began, and it really saved the market. So you had a substantial increase in volume at the end of the day. However, you're still trading within this big red bar, okay? And look at the substantial volume on this red bar. That's telling you that big money, institutions were dumping. And that's what we've been preaching for the last essentially week of rally and upside in this market. The volume has been extremely light, something you have to take into account and notice because it will affect and compromise whether you should be going long or short in certain markets. And when the volume is light, things can pop very quickly and things can drop very quickly as well. But ultimately you broke the trend. Now the key question is, on a daily basis, you are going to be coming into some major support. Just flipping to the hourly here, you do have a gap filled down here, which is likely to be filled. If you look on the daily chart, it's just an intraday gap. So there is the potential that you slice right through it. Now you are going to be coming up to this 200-day moving average on a daily basis for some support. However, I don't think it's going to hold for one simple reason: is you've had a tremendous bounce here with that buy order. So you think about how much money actually flowed into the S&P on the last day just to turn it green and save it from going negative. It was a substantial amount, and that's a substantial bounce above. So usually when something consolidates and bounces before a key technical level, it doesn't make that technical level as strong or sufficient anymore. So that's why I think you definitely slice through it. It would make sense that you go to this gap fill, but ultimately you have your next big range of support here at the 440 area. That's going to be a huge line in the sand. If that breaks, then the markets could start dropping and triggering the algo sell fairly quickly. We wouldn't mind if that happens because we're definitely on the short side of this market. But nonetheless, you should fill this gap heading into the week at some point in time. Jumping into the QQQ intraday action, what's really interesting is these trend lines. So here you have your short-term trend. You broke it. You had your impulse move down, and then you had a bounce off of this trend line. And this trend line was pivot high to impulse move bar, pivot low. And it's really interesting because you found support right on that trend line, bounced, and then you broke it the second time, had your initial impulse move down, your classic retrace up here, touching and kissing that trend line again, failing to confirm above it, and then you had your bigger downside move, little bear flag, and then a complete flush out. And then, of course, you hit this third trend line that we were watching, which connects pivot low, and now, of course, to pivot low. And notice how at each trend line, there's usually a bigger sell-off that occurs. So simply analyzing and having these trend lines in place is a powerful tool. It often helps you mitigate the biggest downside move in the short-term or longer-term trend. In this case, it's the short-term analysis. So where do I think we head next? Well, now that you're trying to test these key pivot low areas, I do think you head lower. Let's just flip to the daily basis on the Qs. Okay, so the next support I have in here is roughly around the 350, 351 area. I think that's going to be a big area of support Reason being, it's one of your biggest areas of volume. Your biggest volume candle is down here at 340. So that's going to be your most critical candle to watch, because once you start breaking that with significant volume, then it could be potentially dangerous and this market could head to the downside. Trading Capital is in the camp that you head to the downside. No doubt what we have seen in terms of the big cap stocks rallying has been lifting and propelling this market to the upside. And when you have companies like Apple, 12 green or 11 green candles in a row, Amazon, Tesla, all of these, Microsoft, all of these tremendous moves, now you're starting to see the decline, and it's really something to be aware of and pay attention to, because look at this on a daily basis. Even the Qs. The Qs are generally weaker in a bear market, and the opposite is true in a bull market. They're usually stronger. So since we're entering a new cycle, a new monetary cycle, the Qs are likely going to be your weakest index. So for instance, on Friday, the Qs are down basically 0.2 basis points. The S&P was up 0.28%, and then the Russell was up 1.12%. So tremendous amount of more downside pressure for the Qs. And if you just look on a technical basis, the Qs have had this tremendous rally up into the 200. And this is the beautiful thing. A lot of people got sucked in, had buy orders waiting just above the 200 in case the trend starts breaking out. But this is the thing that why you should never chase a trend. Because here you peeped up, you closed above the 200 day, and then the next day you opened lower and failed to confirm above that 200 day. And the market was extremely close to putting in a topping tail on a weekly basis. So that was definitely a more bullish sign for the markets. But your big area of support is going to be this red bar coming through and intersecting with this big green bar. But once you start falling in these markets, it's going to really start falling fast. Our thesis here is that the US companies, the large caps in particular, have reached valuations too large relative to their GDP to likely to be able to sustain their fundamental growth rates and valuation multiples, especially when you factor in the policy period that we're entering, which is raising of interest rates and the inflationary pressures. So when you couple those two and potentially have on the horizon stagflation, it is a very high probable outcome that this market has more headwinds than tailwinds, as opposed to the tailwinds that we experienced for the last 3 years. I think we now have headwinds going into the next quarter. Jumping into the Russell. The Russell is interesting because it's been holding up a little bit better. You could potentially go back up to this 212 area or even the 200-day moving average as it is coming down. So it makes sense for the Russell to potentially come up to test its 200-day moving average. The reason for that is you look at the S&P 500 on a daily basis. It broke above its 200 moving average with clear force. The Nasdaq actually tagged and broke above its 200-day but hasn't confirmed above. And notice where the Russell is. It's been the lagger of the market, but there are a tremendous amount of small cap stocks that have been beaten down and could potentially pose some sort of a small little rally here. Now, I mean, you don't have much more to go, and the top could very well be in as you've hit major resistance on this channel. That being said, it's going to be very difficult for the Russell to rally if the two other big indexes are falling and dragging everything down. And it's going to be the big cap stocks. It's absolutely going to be the FANG stocks, the likes of Microsoft, Tesla, Visa, MasterCard. All of these are the institutional stocks, and there is a potential liquidity squeeze and shortage that's going to occur in the not too distant future, just the way economic policy is shaping up. We're going to be getting a lot of key data. And also, what are we heading into? Earnings. We saw in the last round of earnings, stocks that missed were shredded. They were shredded. Now, generally, historically speaking, these big cap companies are really strong in terms of reporting their earnings, and they often post positive earnings. But when you factor in what has transpired, between supply chains, inflation, shocks, the war in Ukraine, certain businesses pulling out of Russia, not being able to sell things to Russia or in those Eastern European countries near there. So there's a lot of things that could potentially be headwinds for the overall big cap stocks, which is why we think there's a strong potentiality and a perfect thesis to be short this market as we head over the next couple quarters into a potential economic decline.